In the last segment, we talked about information overload and how it can lead to decision paralysis, especially for new investors. Now, we're shifting gears to another way technology can mess with our investment psychology: the fear of missing out, better known as FOMO, and the powerful influence of social media. Imagine scrolling through your feed and seeing friends bragging about their incredible returns on some hot new crypto or meme stock. It's tempting, right? Suddenly, your carefully researched investment strategy feels boring and you're itching to jump on the bandwagon. This is precisely the scenario we'll be unpacking today with Sam. Taylor, are you ready to dive into the FOMO frenzy?
Definitely. I think this is something a lot of us can relate to, especially with how pervasive social media is these days. I mean, I've definitely felt that pang of FOMO before, seeing others seemingly making a killing in the market while I'm sticking to my plan. It makes you question if you're doing things right.
Exactly. And that's the first question I want to explore today. How can investors resist that pressure from social media and avoid making impulsive decisions based on FOMO? Sam, what are your thoughts?
Well, the key is to remember that what you see on social media is often a highly curated, often unrealistic snapshot. People are more likely to share their wins than their losses. It's like seeing highlights of a basketball game. You only see the slam dunks, not the missed free throws. So taking everything at face value can create a distorted view of reality. A crucial first step is developing a personalized investment plan based on your own financial goals, risk tolerance, and time horizon. This will serve as your compass, guiding you through the choppy waters of market hype and social media pressure.
So, it's about creating a solid strategy and sticking to it, regardless of what's trending on social media. This reminds me of what we discussed about having clear entry and exit strategies back in episode 31. It's easy to get caught up in the moment, but having a predetermined plan helps you stay grounded.
Precisely. It's about having that discipline. Sam, what are some of the risks of actually relying on social media for investment advice?
The risks are substantial. First, the information you find on social media is often unvetted and can be misleading or outright false. Second, much of the advice is driven by emotion and short-term thinking, which, as we know, is rarely a recipe for long-term investment success. Third, it can lead to herd behavior, where everyone piles into the same asset, inflating its price artificially. When the bubble bursts, those who jumped in late are often left holding the bag. Remember what we discussed about market mechanics and emotional responses in episode 30? Social media can amplify those emotional swings to dangerous levels.
That makes a lot of sense. So, a seemingly hot tip on social media could actually be a sign of an overinflated asset ready to pop.
Exactly. That's why due diligence and independent research are so important.
So, to recap, we've talked about resisting the pressure of social media by developing a personalized investment plan and understanding the risks of relying on social media for investment advice. It's about having a plan and sticking to it. Don't let the fear of missing out drive your investment decisions. The call to action for our listeners today is to develop that personalized investment plan and avoid comparing your performance to others.